by David Madden, who's a market analyst at Equiti Capital. David, thanks so much for taking the time. I guess macroeconomics back in focus with the Bank of England raising policy rates, talking about recession towards the end of this year and a protracted one at that, lasting all throughout next year. We're looking at Europe slowing down, perhaps also the US slowing down. And in the midst of all of this, you have geopolitical tensions in the South China Sea. How are you reading all of this?
Well, I think traders have fallen back into the old attitude of bad news is good news, in that bad news for the economy is good news for the stock market, because everything you just laid out there in your intro, I fully agree with. But if you take a look at the price action of European stock markets, we've seen multi-month highs being posted on the DAX this morning. We've seen the UK 100, the Ftse 100, power on to a new 8-week high, despite the kind of caution from the Bank of England. To be fair, part of the decline in the UK, the Ftse 100, is down to the weakness in the British pound. But I think traders are also taking the view that, you know what, if the Eurozone economy starts to stall, or the UK does enter a recession, or things slow down over in the US, that could then encourage central bankers to actually kind of rein in their interest rate hiking policy. And that's what I mean about people might start to go back to the old style of actually welcoming bad economic news in the short term for the financial markets, because it might contribute to policymakers at various central banks changing their policy, or at the very least readjusting their policy.
Okay, that's perfectly fair, and that's a fair assessment. We're seeing this play out. But from the perspective of corporate earnings, from the perspective of the demand scenario going forward, interest rates going up, the central banks already having raised policy rates quite significantly, targeting demand side inflation, that's bound to have a bearing on corporate earnings down the road. And with the economy overall slowing down, eventually this is going to catch up with us.
I fully agree with that statement. You can run, but you can't hide. Essentially, if you have a scenario whereby your economy does cool down, or you see slow growth, or in some cases actual recession, that is eventually going to catch up with you in some shape or form. Now, although central banks might look to rein in the rate at which they're hiking interest rates, as you mentioned, the corporate earnings, and we've seen it in the last couple of rounds of corporate earnings, particularly from banks here in the UK and around the world, how they're automatically pricing in relatively large amounts of bad debts, and the banking system is kind of like the lifeblood of the business world. So if any of the sectors, be it travel, retail, mining, whatever it might be, if they're slowing down, that's also going to come back and bite the banking sector. But I think a kind of very common theme we're seeing, regardless of what sector you're in, we're talking about higher costs, slower levels of logistics and supply chains that are not back to the level seen prior to the pandemic. In addition to that, we're seeing dwindling consumer confidence. So I think at some point, possibly in the next round of earnings season, we're going to see actually further leg down in stock markets, because, as I mentioned about the kind of bad news being good news, that's very much more of a short-term play. Judging by how central bankers are behaving, at some point that is going to catch up with them. And if the recession here in the UK does come to fruition, I think we are going to see a deluge of profit warnings, and therefore the Ftse 100 is unlikely to be at multi-week highs.
Thank you so much, David, for laying that out for us, and pleasure speaking with you as always.